An insurance policy, sometimes known as a contract of adhesion since you agree to follow the contract's terms and conditions, is a contract between you and your insurer that details the coverage they'll provide you, other policyholders, your belongings, and your residence. On the other hand, an insurance policy is a contract between a person and a corporation that provides insurance. Under the terms of the contract, you pay the insurer regular payments, and they compensate you if an unpleasant event occurs, such as the early death of the life insured, an accident, or property damage. Let's look at what insurance is and what the many benefits, features, and forms of insurance are. For your better understanding, what is a better policy? Let's have a look at once more. A legal contract between the insurance company and the person, business, or entity being insured is known as an insurance policy. Reading your policy ensures that it matches your needs and that you are aware of both your and the insurance company's responsibilities in the event of a loss. Insurance plans, like most legal arrangements, can be difficult to understand. If you look over your policy, you'll notice that it's full with ambiguous exceptions, which might make it difficult to comprehend what's covered under your policy. Many people buy insurance policies without fully knowing what is covered, what is excluded from coverage, and what conditions must be followed in order for coverage to apply in the event of a loss. Consumers should read and comprehend their full policy to avoid complications and arguments with their insurance carrier in the event of a loss. In this chapter we covered: an insurance policy is simply a contract between you and your insurance company that spells out what is and isn't covered, as well as other terms of your agreement. Let's have a look at the basics of an insurance contract. It's crucial to remember that each type of coverage, such as collision coverage, medical payment coverage, liability policy, and so on, may have its own set of exclusions and limitations. You should carefully examine the terminology for the precise coverage that pertains to your loss. An insurance contract has four main components: conditions, insuring agreement, declaration page, exclusions. The conditions. Conditions are clauses in a policy that limit or qualify the insurer's guarantee to pay or perform. The insurer has the right to deny a claim if the policy criteria are not met. The necessity to register a proof of loss with a company, to secure property after a loss, and to participate during the firm's investigation or defense of a liability lawsuit are all common requirements under a policy. The insuring agreement. This is an overview of the insurance company's primary promises and what is covered. The insurer commits to do specific things in the insuring agreement, such as pay damages for covered risks, provide particular services, or defend the insured in a liability case. There are two primary types of insurance contracts. One named perils coverage. Only the risks specifically stated in the policy are covered by this type of protection. It is not covered if the risk is not listed. 2. All risk coverage. All losses are covered under this policy, with the exception of those that are specifically excluded. It is covered if the loss is not excluded. All risk life insurance policies are the most common. The declaration page. The first page of an insurance policy is normally this page. It specifies the insured, the risks or property covered, the policy limits, and the duration of the policy. The description of the vehicle covered, the name of the person covered, the premium amount, and the deductible are all included on the declarations page of an automobile insurance are the example. The name of the person insured and the face value of the life insurance policy will also appear on the declarations page of a life insurance policy. The exclusions. Exclusions take coverage away from the insuring agreement. There are three major types of exclusions. 1. Excluded property. Examples of excluded property under a homeowner's policy are personal property such as an automobile, a pet, or an airplane. 2. Excluded losses. An automobile policy is damage due to wear and tear is the example of an excluded losses. 3. Excluded perils or causes of loss. Flood, earthquake, and nuclear radiation are the example of excluded perils under a homeowner's policy. Examining your insurance and coverage. It's probably a good idea to look over your renter's or homeowner's insurance policy to see exactly what is covered so you know when you can and can't use it. Consider the following scenario: inclement weather causes floods, and you need to file a claim. You'll be out of luck because no policy, whether homeowners or renters, covers flooding. If, on the other hand, a short circuit occurs and your home burns down, burning your belongings, you can file a claim because fire damage is covered under both types of policies. The Property Coverages section contains all coverage details. If you want to know the entire value of the items you're insuring, go to your declarations page, which is usually the first page of your policy. You can also get more information about the cost of your premium, your deductible, and the length of your coverage. In the event of a claim, the insurer pays the policyholder a lump sum payment based on the insurance conditions. Individual demands and life goals guide the selection of a certain type of insurance coverage. A thorough understanding of the many components of an insurance policy can aid you in selecting the plan that is most suited to your needs. There are some of these components to help you better understand what is insurance and how it works. Policy limit. Insurance premium policy. Deductible. Policy limit. It is defined as the maximum amount for which an insurance company is responsible for losses covered by the policy. It is calculated depending on the insurance term, loss or damage, and other similar criteria. Typically, the higher the policy limit, the higher the premium. The sum assured is the maximum amount that an insurer will pay to the nominee under a life insurance policy. Insurance premium policy. An insurance policy's premium is the amount you must pay to obtain a specified quantity of insurance coverage. It's usually described as a recurring fee that you pay on a monthly, quarterly, half-yearly, or annual basis during the premium payment term. An insurance firm calculates the premium of an insurance policy depending on a number of criteria. The goal is to determine whether an insured person is eligible for the sort of insurance policy you wish to purchase. For example, if you are healthy and have no medical history of receiving treatment for serious bodily disorders, you will likely pay less for health insurance or life insurance than someone who has many ailments. You should also be aware that for similar products, various insurance providers may charge varying premiums. As a result, finding the correct one at a reasonable price takes some time and effort. Deductible. The amount or percentage that the policyholder agrees to pay out of pocket before the insurer steps in to settle a claim is referred to as the deductible. You might also think of it as a deterrent to filing tiny, insignificant claims under your insurance policy, which many individuals do. Deductibles are defined by the provisions of a certain type of policy and are applicable per policy or per claim. In general, insurance policies with large deductibles are less expensive since fewer claims are filed due to the greater out-of-pocket expense. Here's a rundown of what's included in a standard policy. What is covered by your insurance policy? How much ground are you covering? Number of your insurance policy. What isn't covered by your insurance policy? Insurance terminology and their definitions. How long are you covered? The cost of your insurance. Your deductible is the amount of money you have set aside for. Thank you for joining us. Hope you will have a beautiful day.